Welcome to the Vaughan Nelson podcast. Today is the third quarter 2025 Vaughan Nelson Select Recap. And with me today is lead senior portfolio manager, Scott Weber. Welcome, Scott.
Thanks, Dan. Glad to be here again. Um, let's start by hitting the touchstone here. We've got two very basic goals at Vaughan Nelson. First is we want to create positive absolute return, and the second is we want to beat the relevant index. Goal one exists because people have real financial liabilities that need to be defeased, whether it's retirement, endowment needs, etc., pension, whatever. And goal two exists because there are competing alternatives to our offering, not the least of which are low-cost index tracking strategies. And while it's true, some investors have thrown in the towel on active exposure for US large cap allocations. If you're listening to this, you're likely pulling for what's a long overdue comeback for active management. As a sidebar, I saw Michael Green speak last week, and it was a nice, it was almost a cheering section for active management. Well, anyway, that comeuppance for passive isn't here yet, but maybe it's here before we know it. And if you look at our positioning, you might come away with the notion that we're growing a little bit concerned about the concentration at the top end of the index. So just by way of example, for the first 9 months of this year, fully half of the return in the S&P 500, that is, was earned by just 5 companies: NVIDIA, Microsoft, Broadcom, Meta, and Alphabet. Let's stick a pin in that because we're going to come back to it in a second later. But as far as a description of the third quarter was concerned, it was all mega cap tech again. So when you look at what we did and how we did, meaning select, from an attribution perspective, industrials led the way with strong performance from United Rentals. Eli Lilly helped our healthcare allocation outperform, and almost all of our consumer discretionary holdings were up nicely. Underweights in staples, real estate, and utilities all contributed to positive relative performance. Lagging sectors were communication services, where Spotify gave back some of the ample gains it's earned in the first half of the year. Information technology, tech, where strong semiconductor performance was offset by weakness in software, and we continue to have a little bit of an underweight position there to tech. And high single-digit performance, just wasn't enough to beat the market in the third quarter. But importantly, there were no specific companies to call out for the weakness. No problem children, no blow-ups. Performance was really pretty reasonably well distributed across all the names. We did swap out one name in healthcare during the quarter, and we added one new name in materials. If you look at the characteristics of the portfolio, it resembles the index from a characteristics perspective. It's pretty close. Where it's different is we're a little bit smaller on the market cap. Again, touching on the point that the index itself is super concentrated at the top end, with mega cap tech. From a valuation perspective, we're basically comparable on a price to earnings, price to cash flow basis. However, we've got, using FactSet data, we've got higher 3 to 5 year EPS growth estimates. And generally speaking, higher growth at a comparable valuation, while coupled with greater factor diversification, should be a winning formula for alpha creation in most markets. And even though we do own some of those names at the top end of the index, this strategy has greater factor diversification, higher ROA, higher ROE, and active share in the low 70s. So net, we have similar factor characteristics, but we're not a monolithic mega cap tech strategy like the S&P 500 has become. If you look at the factors for the strategy, stock specifics during the third quarter were slight tilt negative. Underweight positions in Apple and Tesla were a part of that reason. Spot, as I mentioned earlier, was strong in the first half, but gave a little bit of that back in the third quarter. The returns attributable to style were not terribly meaningful. Long beta partially offset by negatives from short volatility. Industry returns were positive. Highlights were semiconductors, electric equipment, communication equipment, etc. There was a slight negative currency effect of about 30 basis points, which was offset by country effect of positive 38 basis points, both of which stem from our holding in Taiwan Semiconductor. The The portfolio continues to show more systematic diversification than the benchmark. Active risk of about 4.5% is very typical for us, and the stock specific accounts for 87% of the active risk. What does all that mean? It means that we're stock pickers, and idiosyncratic drivers are where the returns are going to come in the portfolio. Flipping over to the macro and the positioning, during the third quarter, we got that much anticipated cut from the Fed. Equity and fixed income markets rallied together. The dollar basically stopped dropping for the year. Gold ripped and really went on a stem. Vol's pretty calm. And now we've got a government shutdown that really doesn't seem to be bothering investors at all. And yet, if you look at the Google Trends measure of search volume for, quote, AI bubble, that hit an all-time this week. Well, it's called a rally when you own it, and it's called a bubble when you don't. We've got healthy exposure here, but we're going to be careful not to be cute with a rally that's appearing less resilient by the day, and for all intents and purposes is likely over-owned. Earnings season is off to another strong start, at least thus far as we're recording this. We will continue to tilt our ear and listen carefully for any companies that might walk back their enthusiasm a bit, particularly when it comes to capital deployment, and especially when it goes to infotech and data center type capex. Given that that spend over the last year has been estimated to have contributed over 40% of this year's GDP growth, it continues to be center stage for the market. And since the top 5 names in the S&P, as I mentioned earlier, constitute about 20% of the weight of the index and over half of the year-to-date performance, it is substantially the only thing that matters right now. We're currently well positioned vis-a-vis the theme, but markets are frankly already adequately positioned for that rally to extend. With that in mind, we're looking elsewhere for tomorrow's gains. We continue to improve the portfolio holdings across the board. In the third quarter, we didn't have any market-wide disruptions, no Liberation Day or anything like that to sort of take advantage of temporary dislocations. But we're keeping a keen eye on that market, which is starting to second guess what has effectively become a daisy chain of financing arrangements and this explosive growth in AI capex. And hopefully the government will reopen for business soon. We'll get jobs data and everything will sort of go back to normal. But in the meantime, we may end up being given a position to opportunity, may be in position to have the opportunity to tilt our posture a little bit as 2025 sprints into the finish. But we'll just have to wait and see. Until then, thanks for your trust, and we're going to keep working hard for you.
Well, great. Well, thank you for that, Scott. With that, we'll take a look at returns. In the third quarter of 2025, the Vaughan Nelson Select strategy returned 7.54% gross, 7.28% net, versus the S&P 500 at 8.12%, which brings the year-to-date return for the Vaughan Nelson Select strategy to 13.97 gross, 13.13 net, and 14.83 for the S&P 500. Over the past year, Vaughan Nelson Select strategies returned 13.95% gross, 12.83 net, against the S&P 500 at 17.59%. Of course, the past 3 years, 18.46% gross, 17.29% net, and 24.93% for the S&P 500. Over the past 5 years, this Vaughan Nelson Select strategies returned 15.6% net, 14.46 gross, and the S&P 500 is at 16.47%. And finally, across the last 10 years, the Vaughan Nelson Select strategy has returned 14.87 gross, 13.74 net, and the S&P 500 is sitting at 15.31%. With that, that's a wrap on the third quarter. So thank you very much, Scott, and we'll have you back in here soon.
The views, information, and/or opinions expressed during this podcast are solely those of the individuals involved and do not necessarily represent those of Vaughan Nelson and its employees. Vaughan Nelson does not verify and assumes no responsibility for the accuracy of any of the information contained in the podcast. The primary purpose of the information, opinions, and thoughts presented in this podcast is to educate and inform. This podcast, or any podcast in the series, does not constitute professional investment advice or services, and any reliance on the information provided is done at your own risk. Past performance is not an indication of future performance. By accessing this podcast, you acknowledge that the entire contents of this podcast are the property of Vaughan Nelson or used by Vaughan Nelson with permission and are protected under U.S. copyright and trademark laws. Securities discussed within this podcast may be held in the Vaughan Nelson strategies.